It's a Tuesday morning in late 2012. Outside a county courthouse in Georgia, about 200 people are standing in line. They're not here for jury duty, they're here for a foreclosure auction. 900 homes are about to go on sale. Families lost them, banks took them back, and now they're being sold off on the courthouse steps. But here's what nobody in that crowd expected. One company, a company most of them had never heard of, walked away with 1,400 homes in a single day in one city, and that was just the beginning. Over the next 4 years, that company would spend $10 billion buying up nearly 50,000 foreclosed homes across America. At its peak, it was spending over $150 million a week just on houses. They didn't flip them, they didn't tear them down. They rented them back to the same kind of families who lost them. And the man behind this entire operation, he sketched the idea on a yellow legal pad. One page, one concept. That concept would become the largest home buying operation in American history. So let's trace how one Wall Street firm turned a housing crash into a rental empire, and how that empire is still shaping what you pay for a place to live right now. Jonathan Gray grew up in suburban Chicago. His dad ran a small auto parts factory. Get this, the factory was called Blackstone Manufacturing. It had nothing to do with what came next, but the coincidence is almost too perfect. Gray went to the University of Pennsylvania, double degree, Wharton Business School, and English literature. He joined a firm called the Blackstone Group straight out of college in 1992. He was 22 years old. Now, here's the thing about Gray. He wasn't a flashy Wall Street guy. No headlines, no yachts. People who worked with him described him as quiet, obsessive about data, and genuinely uncomfortable talking about his net worth. But what he could do better than almost anyone was spot a pattern before the rest of the market saw it. And in 2011, Gray spotted the biggest pattern of his career. America was drowning in empty houses. The 2008 financial crisis had triggered over 9 million foreclosures. Entire neighborhoods in Phoenix, Atlanta, Las Vegas, Orlando were full of vacant homes, lawns overgrown, windows boarded up. Prices had crashed by 40, 50, even 60%. Banks were desperate to get these properties off their books, and Gray saw something nobody else was thinking about at that scale. What if, instead of waiting for families to buy these homes back one by one, you bought thousands of them, fixed them up, and rented them out, not as apartments, as single family homes, houses with backyards and garages and good school districts? He pitched the idea to Blackstone's leadership. The whole plan fit on a single yellow legal pad. They called the new company Invitation Homes. What happened next was unlike anything the American housing market had ever seen. Blackstone didn't buy homes the way a normal person does. No browsing listings, no open houses, no mortgage applications. They showed up at foreclosure auctions with teams of bidders and cashier's checks. They bought homes in bulk directly from banks, the same way you might buy toilet paper at a warehouse store. One report described their reps at a Georgia courthouse as an army of bidders. In one move, they picked up 1,400 homes in Atlanta in a single day. By 2013, they were spending $100 million a week, every week, just on houses. The homes they bought were incredibly cheap. The average purchase price was around $153,000 for properties that had been worth more than $300,000 just a few years earlier. And they weren't buying randomly. Gray's team used data to target specific neighborhoods, places where jobs were growing, where schools were good, where people wanted to live but couldn't afford to buy anymore because the crisis had wrecked their credit. That last part, that's the key. The same financial crisis that flooded the market with cheap homes also created millions of people who needed to rent. Credit scores were destroyed, savings were wiped out, banks weren't lending. So Gray had both sides of the equation, a massive supply of cheap houses and a massive demand for rentals. By 2016, Invitation Homes owned 48,000 single-family houses across America. No company had ever done anything like it. But buying the houses was only step one. Now here's where it gets really interesting, because what Blackstone did next turned this whole operation from a real estate bet into a financial machine. First, they bundled the rental income from thousands of homes and sold it as a bond. Think about that for a second. They took your monthly rent check, packaged it with thousands of other rent checks, and sold that stream of payments to investors on Wall Street. It was called a single family rental securitization. It had never been done before. Deutsche Bank, Credit Suisse, and JP Morgan helped structure the first one, a $439 million bond offering. Sound familiar? It should. Bundling housing payments into securities is exactly what happened with mortgages before 2008. The same banks, the same structure, just a different product. Second, in 2017, they took Invitation Homes public. The IPO raised $1.5 billion. It was the largest single-family rental IPO in history. And third, and this is the part most people miss, Blackstone cashed out. Between the IPO and a series of stock sales, Blackstone made approximately $7 billion on its original $10 billion investment. By November 2019, they'd sold every single share. Jonathan Gray called it a success. He told the Wall Street Journal, "The hardest part wasn't buying the homes, it was building the business." But here's what was happening on the other side of that business. Today, Invitation Homes owns over 86,000 single-family houses. It pulled in $2.7 billion in revenue in 2025 alone. Average occupancy sits above 96%, and it's not alone. American Homes 4. Rent owns about 53,000. Progress Residential has over 83,000. Blackstone came back for more in 2021, buying Home Partners of America for $6 billion and then acquiring Tricon Residential for another $3.5 billion. Altogether, by the end of 2025, investors accounted for roughly 30% of all single-family home purchases in America. Now let's talk about what this means for you. If you rent a house in a city like Atlanta, Phoenix, Charlotte, Tampa, or Dallas, there's a real chance your landlord isn't a person. It's a publicly traded company. Your rent check doesn't go to a guy who owns the building. It goes into a revenue stream that gets reported in quarterly earnings that Wall Street analysts evaluate and that shareholders expect to grow. And when shareholders expect growth, rents go up, not because your landlord needs more money, because the spreadsheet says they should charge more. Invitation Homes reported blended lease rate growth of over 4% heading into 2026. Renewal rates pushed even higher, nearly 5%. That's not inflation, that's a business model. Here's the dinner party version. Imagine a company buys houses during a crisis when prices are at their lowest, rents them to families who can't afford to buy, raises rents every year, and reports the profit to Wall Street. That's not a hypothetical, that's the business. Now, to be fair, this story has another side, and it matters. When Blackstone started buying homes in 2012, those neighborhoods were in real trouble. Vacant houses attract problems, property values spiral down, communities suffer. Blackstone says it invested an average of $25,000 per home in renovations. They argue they stabilized neighborhoods, created jobs, brought professional management to a rental market that was historically run by small-time landlords with no accountability. And the numbers on overall market impact, they're smaller than you might think. Institutional investors, the big companies that own over 1,000 homes, hold less than 1% of America's total single-family housing stock. Most single-family rentals are still owned by small, local landlords. But here's the tension. While their national share is small, their presence in specific markets is enormous. In cities like Atlanta, Charlotte, and Phoenix, institutional landlords own a much larger piece of the pie. And when you're competing for a starter home in those markets, you're not just bidding against other families. You're bidding against a company that pays cash, closes in days, and doesn't need a mortgage. In January 2026, President Trump signed an executive order aimed at restricting large institutional investors from buying single family homes. Congress has proposed bills to ban companies that own more than 100 homes from buying any more. But here's what's already happening. The largest investors are now net sellers. They're pivoting to something new, building entire neighborhoods from scratch, specifically designed for renting, not converting existing homes, building new ones that were never meant to be owned by the people who live in them. The model isn't going away, it's evolving. So let's come back to where we started. A Tuesday morning, a courthouse in Georgia, 900 homes on the auction block. That moment in 2012 was the beginning of something that changed the American housing market permanently. One man sketched an idea on a yellow legal pad. That idea became a company, that company became an industry, and that industry turned the single family home, the most basic symbol of the American dream, into a Wall Street asset class. Now think about this for a second. If you are renting right now, look at your rent payment this month. Ask yourself, where does that money actually go? Does it go to a person or does it go into a quarterly earnings report that a company uses to tell shareholders the business is growing? And if you're trying to buy a home, ask yourself why the starter homes in your area seem to disappear before you can make an offer. The answer might not be what you think. Follow the money, see the system. If this video opened your eyes to something you didn't know, hit subscribe. We trace the hidden financial systems inside the companies you deal with every day. And the next one, it's even bigger.